Tesla stock has not been doing too well recently, and I believe there are two main categories that help explain why this has been happening. Number one, the larger picture stuff. The larger macroeconomic conditions are not so favourable right now. And number two is more Tesla specific factors. And we are going to cover both of those in this video. Firstly, we will cover the more zoomed out stuff. And this stuff doesn't just impact Tesla stock. This is way more broad than that. It's impacting the market in its entirety, especially tech stocks, which we'll speak about in just a minute. But from my personal perspective in my portfolio, I'm seeing big declines in Tesla, Palantir, Amazon, and Alphabet. But those four are my largest holdings in that portfolio. So it may just be an accumulation of the factors that are impacting the stock market, but also the fact that if you've got a larger position in one stock, you are going to see those downturns and those upward swings way more dramatically. So before we talk about how Tesla stock is falling, let's just look at this from a wider lens. So year to date, from the beginning of the year all the way up until the earnings, Tesla stock is up by about 170%. This increase in this space of time is pretty crazy. And in general, when a stock rises so much in such a short space of time, we expect to see some sort of pullback, a correction. It's healthy, and it's healthy for the market in general. This kind of growth, so 170% in 6.5 months, is not sustainable in the long term. So it's always going to happen that the stock then needs to drop and consolidate a little bit. If you look at an index like the QQQ or the S&P 500, or even if you take an individual stock like Tesla, what you tend to see is that it will have a run up, and then it will have a pullback and consolidate a little bit before having another run up. Then it will consolidate and pull back a little bit, and so on and so forth. And over a long period of time, there is a general upward trend. Of course, it's not always this simple, and it's not always just a quick run and then a pullback, quick run and then pullback. It's a bit more volatile than that over different time periods. But overall, this is kind of what happens. Apart from if you obviously have a stock that is just plummeting to its death and it's never going to go anywhere, there's always exceptions, of course. You may also notice that there has been a larger dip in the QQQ compared to the S&P 500. Or if you just search individually for different stocks, you'll probably come to notice that over the last 1 month time period especially, there has been a larger pullback, a larger dip, a larger correction in those tech stocks compared to others. Just like those were the ones having the largest run up in recent months before we've started seeing this dip. Of course, what goes up must come down. I believe mega cap tech stocks have actually been having their longest downward streak in 2023 so far. I believe that they've actually seen 3 whole weeks of red day after red day after red day. So of course, as an investor, investing into indices with a high percentage of those tech stocks or holding those positions individually in your portfolio take quite a toll. And it's not very nice to see that your entire portfolio was doing so well just a few weeks ago, and now you're seeing red, you're seeing massive declines in the positions that you hold. But that's where the psychology of investing really comes into play. Anyway, recently we have been experiencing quite a negative macroeconomic situation. The conditions just haven't been there to support and haven't been reflective of the large bullish run-up that we've been seeing. So it does make sense for the market to actually flip itself on its head, and we are now seeing a correction of that. In July, we had the Fed meeting where they decided to hike rates up. And this, of course, can slow down the growth of stocks because investors are looking to take their money out of the stock market and actually put that money elsewhere. Also, if you've been following the news, you may have seen some recent headlines around GDP and how it's actually been rising. And it's been predicted that it's going to hit 5.8%. Double check that. I think it was 5.8% that I read. For this quarter that we're in right now. Just to give you some context here, in case you don't actually follow this and you don't really care too much and you just want a high level overview, this is the highest GDP growth forecast for the third quarter that we've seen since 1984. And it's been put down to a few different factors. Number one, a continued strong job market. The unemployment rates in the US are the lowest that they've been in about 50 years, and this helps to boost consumer spending. Also, an increase in business investments, which again helps boost economic growth. And the other reason that I can see in play here is that there's been an increase in new house construction and industrial production in July. I should give some context here actually. GDP is basically a way to measure the economic growth. So when the economy grows too quickly, it can actually lead to higher levels of inflation. So one thing that happens sometimes is that interest rates are actually hiked in order to deal with that. So because we're seeing this increase in GDP, people are starting to think that this could mean that the economy is growing too quickly, and therefore we could end up seeing a hike in interest rates. So people are predicting that that could be coming up in the future and probably getting a little bit panicked about that. We could see that the Fed actually pause interest rates or they go on to hike them again. I guess time will tell there. We are also seeing that the yield of the US Treasury bonds are going to their highest that they've been since 2011. Higher bond yields basically mean that investors are more likely to put their money into them as opposed to putting their money into the stock market, because these bonds are giving really good high yields and it's less risk because it's backed by the government than if they were to put their money into the stock market. And of course, the return in the stock market is a little bit more risky and it's it's way less known actually. You don't really know what you're going to get. No one can predict it over short periods of time especially. Again, if these bond yields continue to rise, the Fed could decide to increase interest rates. And then we need to talk about China. This is having a massive impact on the macroeconomic conditions that are out there right now. So whilst we have the US fighting inflation, we have China actually battling quite the opposite problem, deflation. Since the pandemic and lockdowns have been easing, so on and so forth, especially in China, we kind of expect to see that this opens the Chinese economy up and there should be very, very good growth. But actually, China's economy is not really seeing that much growth. They are seeing a decline in the demand for exports, a small growth of GDP, and their real estate market has been in a downward turn. So now they are entering into deflationary territory. So now there's concern that what's happening in the second largest economy in the world, China, that is now going to start being very impactful for the rest of the world's economy, especially the US, because China is a major trading partner for the United States. So a slowdown in the Chinese economy may actually cause a decline in the US exports to China. Also, we know that China are a key component in a lot of supply chains for a lot of companies around the world, and especially talking about these big US companies. Having said that though, since everything that happened in 2020, a lot of companies have decided that they didn't want this impact in supply chain to happen so easily again in the future, and have actually decided to shift to other countries nearby, such as India and Vietnam. Obviously, there is also the concern about the impact that this will have on the demand for Tesla in China too. Then we have the Fear Greed Index, which is actually really interesting. So if you've never heard of this, after this video, go and Google Fear Greed Index and actually read about it. It will definitely give you somewhat of an insight. It is not the definitive thing that you should use when making investment decisions, of course, but it's interesting nevertheless. It's basically a tool to help measure the levels of fear and greed in the stock market, and it does so by basing that on about 12 different indicators. But right now it's coming out as neutral, but it's very close to tipping over into that fear category. But just 1 month ago, it was sitting at being extreme greed. So there's been a massive flip here in just a short space of time with how the investors in the market are feeling. If we do end up tipping over into that fear category, we could actually see that there's less money in the stock market and perhaps more sell-offs as well. If I've missed any macroeconomic factors that help explain why Tesla and just the market overall have been falling recently, please drop them in the comments below. But now we will talk about Tesla specific factors. Clearly, the stock has taken a massive hit since Tesla announced their earnings on the 19th of July. So what has actually happened aside from just the macroeconomic situation we've just discussed since that date? Well, maybe just some general trading has taken place. Now, of course, Tesla is one of the most traded companies out there, and earnings in particular is a very traded event. Earnings weren't that bad bad in my opinion anyway, but maybe they weren't exactly what people were hoping for. So maybe there's been some sell-off from individual investors, but also from institutional investors as well. We've recently heard that ARK Invest have sold some Tesla shares, so who knows what else is going. We'll have to wait until the 13F filings come out to actually see who's been selling and who's been doing what. We've had a lot of news and a lot of noise, as always, about the Cybertruck, about Giga Mexico and other things, but maybe people are getting a bit annoyed. Maybe people aren't very happy with the undefined deadlines that surround these catalysts, and maybe they're just not really understanding how long they want to hold their stock for, and that may be causing some people to sell off as well. Now, these things that we've just spoken about, these however many I've just said, aren't really going to explain fully why Tesla stock may be actually going down recently. But I believe there are two big reasons for this that are Tesla specific. And these are that the CFO, Zachary Kirkhorn, actually stepped down after serving for Tesla for 13 years. And he was actually quite a favorite by a lot of Wall Street analysts and individual investors alike. He was seen as a real asset to Tesla and helped Tesla achieve some amazing things. So people are concerned now about what this means for Tesla as a company moving forward. And the second thing here is the price cuts in China. Now, I've spoken about this in a recent video, but they've announced price cuts in China specifically on a couple of models, and I think that people are getting very panicked about this. When I say people are getting panicked about this, I mean individual investors, but I also mean that these are quite big deals, these price cuts, for Wall Street analysts and then for institutional investors as well. Because quite often you hear about a price cut and people think that this means price cut equal lower margins, equal lower revenues, equal, the stock not doing well in the future. And this can cause Wall Street analysts to actually reduce their stock price predictions for Tesla stock based on these price cuts. I've spoken about my thoughts on this in previous videos, so I'm not going to go into it too much. But these price cuts do seem very, very strategic for Tesla. It seems as though they are cutting prices in order to really aim for the volume of sales to increase. They want to grab as much market share in the Chinese market as they possibly can. There's obviously increased competition in China in terms of BYD, and it's an important market to try and actually dominate as much as possible because, like we just said, China is the second largest economy in the world and they are a massive player in the EV field especially. Also, it makes sense that Tesla just want to get as many cars out there to consumers as possible so that they can collect as much data for solving FSD and eventually the robo-taxi fleet. So we know that anytime Tesla announces a price cut, there tends to be a dip in the stock price following shortly after because it freaks a lot of people out. And I mean, I obviously hope as a Tesla investor that they level out eventually. But I also understand that it seems very strategic as to why they're doing this when they're doing this, rather than it just being for a demand issue and that they're panicking and they are absolutely forced to do this. I don't think that's the case. But obviously everyone can have their own opinions here, and I'm putting my money where I have strong conviction, just the same way as you should put your money where you have strong conviction. Another thing to remind people of is what Elon said during earnings, and that is we continue to target 1.8 million vehicle deliveries this year. Although we expect that Q3 production will be a little bit down because we've got summer shutdowns for a lot of factory upgrades. So just probably a slight decrease in production for Q3. But basically what he's saying is expect lower numbers in Q3 because they are doing factory shutdowns. It makes sense. They are improving their factories. They're doing upgrades. Therefore, we will see this knock on to the numbers a little bit. So we've been told to expect some decreases in the numbers and that things might slow down a little bit, but we've been given reason as to why that's happening. So I do wonder when these numbers are actually released, whether people will remember what we've been told and why it's happening, or whether people will freak out and believe it's a really bad demand issue. But I guess time will tell on that one. But Tesla nevertheless are continuously working to improve the efficiencies in their factories, because what this does is it allows them to produce each vehicle for a smaller price. And then this means that they can pass on these price savings to the consumer and get more sales that way. Obviously, the cost that it takes to produce each vehicle, along with the revenue, the amount that they sell each vehicle for, and all of that stuff comes into play and affects the gross margin. And when we see gross margin falling ever so slightly because of the price cuts, I mean, they're still market leading, but we're seeing it falling, people are panicking. But behind the scenes, Tesla are working really hard on actually improving efficiencies to bring down the cost of production even further than they currently are. So let's see what happens with these numbers in the next few quarters coming up and in the long term in general. Thank you for watching this video. I really appreciate all of you guys that tell me that you enjoy the videos and leave nice comments and like the videos and just showing support in general. It means a great deal to me, honestly. So thank you so much for watching, and I'll see you in another video very soon.